All right, in this video, we're going to identify and describe known current liabilities. There are a number. Is my pen working? Excellent. Okay, so there are five or six. So we have accounts payable. Man, we already know that one. Sales taxes we'll go over. Unearned revenue we're going to go over in this lecture. Notes payable we will also go over in this lecture. Payroll obligations, I'm going to wait until the next lecture to cover that. And then we'll finish this up with multi-period known liabilities. All right. So I don't even think we have to deal with accounts payable. So we can just jump right into sales taxes payable. And I actually don't mind the PowerPoint slides. In this particular example, on August 31st, Home Depot sold materials for $6,000 that are subject to a 5% sales tax. So in California, we pay sales tax. And what's happening here is we're Home Depot. We have customers coming into our store, and the goods and services that they are purchasing are worth $6,000. However, we also charge them a 5% sales tax. And so we're really saying, hey, listen, the total amount of your purchase is $6,300. Okay. However, the $300 that goes to the sales tax portion, that's not something that Home Depot keeps, right? Home Depot is collecting the sales tax and then sending it off to the local municipalities, right? Or they could be sending it off to the state of California. So when the customer pays $6,300, we're obviously receiving cash, right? So we would debit cash of 6,300, and then the revenue portion that Home Depot earns is that 6,000. However, the $300 in sales tax, we are going to have to send that off to the taxing authorities. So it's not really ours. It is our obligation to forward off. And so we're going to treat it as sales taxes payable. Sales taxes payable is obviously a liability. And if we want to increase the liability, since it's on the right-hand side of the accounting equation, we're going to do it with a credit. So we would credit sales tax liability. And then when we were to pay, right? I guess we're not, bear with me. But if I were to pay the sales taxes payable, right, I would send this off to, come on. I would send this off to the taxing authority, and I would just say sales taxes payable, 300, and cash, 300. Okay. Okay, next category, unearned revenue. Man, we've already covered this, right? I don't know that we have to spend too much time on it here. But in this particular example, hey, kind of a cool example. On June 30th, Selena Gomez sells 900,000 in tickets for 3 concerts, right? So on the day that Selena Gomez tickets go on sale to the general public, she hasn't earned revenue yet, right? Because she can't earn revenue until she actually goes out and performs, where she performs the service. So on the day that she makes the sale, it's a debit to cash, and then it's unearned ticket revenue, right? She hasn't earned this yet. So it is actually a liability. And then on October 31st, when she performs at least one of the concerts and earns 1/3 of that unearned liability, we would move $300,000 from unearned revenue into the revenue account. So if I had from transaction one unearned revenue and I created a $900,000 credit after October 31st, I'm going to lower unearned revenue by 300, right? And then I would recognize the revenue. The performance revenue, sorry. Okay, notes payable. Okay, accounts payable. Man, killing myself here. Short-term notes payable. And they really could come of two things. The most common is probably going to be borrowing money from a bank. Um, but we could create notes payable if we originally sold some products and services to a customer. Man, I'm killing myself. If we purchased products and services from a vendor and we initially created an accounts payable, and if for whatever reason we couldn't make that payment on time, it could be the case that we say, hey, listen, let's convert our accounts payable, let's convert the obligation to a note payable, and we could start paying interest. That way, the vendor is happy with the arrangement. They're not happy with it, but they're at least being compensated for the fact that we haven't paid yet. Okay, so in this particular example, on August 23rd, Brady Company asks McGraw to accept a $100 cash and a 60-day 12% 500 note to replace its existing $600 in accounts payable. So what we're saying is we have this accounts payable balance of 600, and what we want to do is we want to say, hey, listen, we'll pay you $100 in cash, and then we're also going to create another note payable, and that way we'll pay interest on at least the amount that we haven't paid yet, right? So we would debit accounts payable for 600. That way we're satisfying the accounts payable obligation. We're obviously crediting cash for 100 because that is the part that we are satisfying now. And then we're saying the remainder, we will create a notes payable. And the note payable, it's subject to 12% interest. Okay. That's an annual rate. But at the time that we convert from accounts payable to notes payable, we don't really worry about the interest just yet. The interest will become due the longer that we hold that note payable. Okay, so now sometime later, on October 22nd, Brady pays the note plus the interest, okay? So look, we had a $500 note payable, and it was subject to 12% for an entire year, right? I can't do that in my head, but 500 times 12% is 500 times 12% is $60. But that's an annual number, right? Every time we see the interest rate, it's always an annual number. So we need to then convert 60 to a partial year, and our treatment is always 60 over 360. Remember, we're using the bank approach. We just assume 360 days a year, right? And that accounts for leap years and so forth, et cetera, et cetera. Okay, so 60 times the ratio of 60 days out of 360 days is going to leave us with $10, right? So the day that we pay, okay, we're going to pay a total of $510. 500 of that is going to relate to the principal amount that we owed, the original $500 note, and we're also going to pay interest, right? So notes payable, that was initially a credit since it was a liability. And if I'm going to lower that account, I'm obviously going to lower a liability with a debit. And then interest expense, that is an expense and it lowers our equity. And we were saying if we wanted to lower equity, we would do that with the left side of those T accounts. We have a different situation. Okay. In this situation, we're going to borrow money from a bank. And on September 30th, we're going to borrow $2,000 and we're going to borrow it for 60 days and it will be subject to 12% interest. So on the date of us borrowing it, we're obviously receiving $200 in cash from the bank, and cash is an asset. If I want to increase an asset, I'm going to do it with a debit. So we would debit cash and then we would credit the note payable. Note payable is a liability. We already know that. If I want to increase a liability, I would do it with a right side of the T account. We know that as well. All right. And again, at the time that we borrow the money, we don't worry about any interest. Okay. On November 29th, the day that we pay the note, that's 60 days later, we will lower the note payable by debiting note payable by 2,000, but then we have to pay interest. And again, the interest expense is going to be the 2,000 times the 12% rate. And remember, that's always an annual rate. And so whatever the annual rate is, we have to adjust it down to the partial year. And we're always going to use that 360-day approach. So we would multiply it by the ratio of 60 divided by 360. So 2,000 times 12% times the ratio of 60 days over 360 in a year is going to leave us with, and I can't do that in my head, but I'm cheating. It's $40. And that is a $40 interest expense. And so we would debit interest expense by $40. And therefore the total cash we pay, principal and interest, $2,040. Now, there are complexities, right? When we borrow money and it is outstanding from one period to the next, okay? What do I mean by that? Maybe I could use this prior slide. What we're saying is I have two terrible, that's just the worst. Yeah, I was going to say, oh, too bad I couldn't delete that. But I have two accounting periods, right? This is accounting period 1 and this is accounting period 2. And what we're saying is, hey, I'm going to borrow some money in accounting period 1 and then I'm going to pay it back in accounting period 2. All right? So in reality, what we're saying is, hey, listen, accounting period 1 is going to be subject to interest expense because that was the period we were obligated to pay it back and we were incurring interest charges from the date of issuance or the date that we borrowed it all the way to the date of the financial statements. And this would be the date of the financial statements. Usually it's December 31st. But then after December 31st, we continue to accrue interest, right? Until we pay the note back. And so that's all this slide is trying to articulate. But maybe we look at an example, okay? So in this example, on December 16th, 2021, we're going to borrow $2,000 from a bank. And again, we're going to agree to pay 12% interest. And we're going to borrow it for 60 days. We already know what the journal entry looks like to borrow the money. We're going to debit cash of 2,000 and we're going to credit note payable of 2,000, right? And we do that on December 16th. But then when we get to December 31st, we have to record the interest expense that we incurred, right? We received some benefit from December 16th all the way to December 31st. And therefore, we need to recognize the expense associated with that receipt of that benefit. So we would do 2,000 times that 12% annual rate. And now we've only had, 15 days in December from the 16th through the 31st, not including the 16th. That is 15 days. And it's still out of 360. It's not 15 out of 60, right? Again, it's 15 out of the entire year. So if I were to do all of that math, that's $10. All right. So I have to recognize in this first period, right, $10 in interest expense, even though I'm not going to make the payment until 2022, right? 60 days past December 2021. Okay, so how do I record that? It's interest expense of $10. And look, I'm not sending a payment. I'm not paying until the end of 60 days. So I would create interest payable. All right. Then 60 days goes by since we borrowed the money on December 16th, and now we're ready to pay. And so, man, the first thing we have to do is figure out how much are we actually paying. So we have to kind of do this calculation again, but now we have to do it for the full amount because that's really what we have to pay. So I would do 2,000 times that 12% for the entire year. Then I'm going to adjust it for the entire amount that I was obligated to pay interest. That was 60 days out of 360 for a total of $40. Okay. However, we already know that this entire period, right, I'm obligated to pay $40 in interest. Yet we've already recognized 10 in the previous period, and therefore we're going to recognize 30 in the second period. And so the first thing I'm going to do is debit interest expense by $30. All right. And then I'm paying everything back. I'm paying the original 2,000 back, plus I'm paying that $40 in interest, right? The total amount I'm paying is 2,040. 30 of it relates to the interest expense in 2022. 10 of it relates to the interest expense and the interest payable that I created from 2021 right up here. And so we're going to pay that back. So I would debit my my interest payable that we created from the previous step. So in February, we're now paying that. So I would debit interest payable, which is that. We just accounted for that. And then I'm obviously going to debit my notes payable, right? When we issued, or when we borrowed it, I should say, we were obligated to pay back 2,000. We're paying it back in this last one. So I would debit my note payable account, and then I'm going to credit cash for 2,040. Okay, the last element of known liabilities, not including salaries, okay, is this multi-period liability. And what we're saying really is, hey, what if I were to borrow $500,000 from a bank, and I said that I'll pay it back in equal installments over 5 years. So every year I will pay $100,000. Okay. The day that I receive this 500, I'm going to create a liability that is what we call notes payable, and we'll put $500,000 in there as a credit. However, when we present that 500,000 on the balance sheet, we're going to show 100,000 in the current period. And so we'll call it the current portion of long-term liabilities due. So of the 500,000, since I'm paying it back in equal installments over 5 years, 100,000 is going to show up in the current portion, and then 400,000 will be the amounts that are due, but they're due longer than 1 year. And unearned revenue, that could be the same, right? We could be providing services, and somebody could pay for services that are anticipated to extend beyond a year. So then we would show unearned revenue, some portion of that we're going to earn in the current year. And then we would show the unearned revenue that we anticipate earning in the following year, some other in the long-term liabilities section.